Hello, investors. It's Don Vandenbord, Senior Portfolio Manager at Revere Asset Management. Today is Friday, July 16th, 5:02 p.m. Eastern Time, and I am coming to you from St. Augustine Beach, Florida, with tonight's big version, the big show, the expanded version of the Revere Market Insight video, where we take a look back at the prior week, look ahead at what you need to know for next week, and update the 21 over 21 leaders list. Take a look at how sectors are doing and discuss some trades that we made in-house this week. So let's get right to it. State of the market. I've changed it to bifurcation. For a while we had uptrend here, but we've been saying for a while it's in an uptrend for big cap stocks, but small and medium caps are really suffering. Oh, and by the way, the QQQ is doing so well that you need to almost stay away from it because it's due for a harsh pullback. So just summarizing things up into bifurcation, even though over here we are still showing green arrows across the board. However, yellow arrows, the green arrows indicate bullish. The yellow arrows indicate the trend of where we are, whether we're solidly bullish, leaning toward neutral, and both for the short term and medium term, we're leaning very much toward neutral. You could almost say we're between neutral and bullish here, but what we're trying to do is identify what's lagging and what's leading. And as Hunter indicated in last night's video, the market leaders have also, we put a yellow arrow on there as a few of them broke down this week. So that's where we are across the board. Short term, we use the 21-day exponential moving average to track where the 5 indexes are. Medium term, the 50-day moving average. Long term, the 200-day moving average. And market leaders is really referring to our portfolio and how growth leaders are acting, particularly in the 21 over 21 leaders list that we maintain here at Revere. So what just happened? Red finish to a red week. You can see here S&P and Nasdaq 100 both down about 0.8%. Dow similar, mid caps down 1.2, as well as small caps. Mid caps and small caps really got hammered this week. So the S&P, the Nasdaq 100, and the Dow were all down 0.6% to 1%. Mid caps and small caps down 3 to 5% on the week. There was really some carnage there. Led to the downside by oils and financials. We're going to take a look at the sector charts as well as the index charts here momentarily. So let's get to it. But first, let's get to the lovely faces of the guys running Revere Asset. And if you're interested in speaking to a conflict-free, completely transparent, registered investment advisor who is passionate about educating clients and market lovers about what we consider the common sense way to approach. Why would you sit there like a deer in the headlights when your market is shrinking, when your portfolio is shrinking 34% in a 5-week span during COVID? That's not how we do things here. We monitor the market trend, identify the strongest sectors within that trend, and then the best stocks within those sectors. We get on board those and we ride them until they start to show weakness. So if you're interested in this approach, we'd love to talk to you. Here's our fearless leader, America's fiduciary, Dan Stewart. You can email him, dan@revereasset.com. If you call our toll-free number, he's the one that's going to answer. That's 855-REAL-WEALTH, 855-732-5932. Or you can email any of the guys supporting Dan. That's Tim, Hunter, Alex, or Don at revereasset.com. Let's take a look at a secondary indicator that I think is important here, and that is the fear and greed indicator, which is showing quite a bit of greed. In fact, it's into, quite a bit of fear. It's into extreme fear at a 23. This isn't a pure sentiment gauge, although sentiment over the last 2 weeks, bearishness has come down also, but this is actually a contrarian indicator, and the more fearful you get, the more optimistic we actually get about a snapback in the market, and that's why we always keep our leaders list updated and ready, and we are prepared for all situations here at Revere. So good news or bad news is good news in this case when you're looking at fear and greed. So let's get to the charts here. We're going to start with, as always, the S&P 500. Let me blow this chart up a little bit. Ugly week. As you can see, closing at the bottom of the range for the week. We had a shakeout last Thursday and then closed at the high, in fact, new all-time highs for the week last Friday. That was followed up with another all-time high close on Monday. However, Tuesday, let's take a look at a 10-minute chart here. Tuesday, right here at 1 o'clock, news came out that the 30-year bond auction was very weak. Now, I don't normally follow these things, but I did see the headline, and then I also saw the reaction to stocks to that headline. They trended lower for the rest of the day. No problem, gap up on Wednesday, right? New all-time highs, right? Well, we gave that up pretty quickly, although we did try to bounce back in the afternoon. Then another gap down on Thursday. Harsh sell-off late in the afternoon, but bounce back near the close. Big gap up, feeling good, right? Nope, that's the high for the days. Harsh sell-off, a little bit of late morning to early afternoon consolidation, but that resolved lower, and we closed near the bottom of the range for the week. So all in all, for the week, not a good week, but with respect to where we have been, it's a reasonable pullback, and we're still above the 21-day exponential moving average, which is what we consider key to the health of the market, and 2.1% above the 50-day moving average. 2.1%, and by the way, our maximum drawdown right now is going to be between 2 and 3%. That means if all of our stops got hit over the next week from where our accounts are right now, we would be the equivalent of all in cash between 2 and 3% to the downside. So that's what our risk is. Nasdaq 100, the leading stock for a long time, or the leading index for a long time. Since 7/2, we've had the red warning arrow on saying be careful of a pullback in the Nasdaq 100, and that was because that was the first time we closed over 6% above the 50-day moving average, and also 3.4% above the 21. Those are extended, and normally you don't make a lot of progress and your risk is to the downside. We continued to trend sideways to higher, kept that on until yesterday. We took it off short term as we corrected enough to where we're within 1.7% of the 21, and now we're taking it off today on the intermediate term as we're back under 5% away from the 50-day moving average. I've been talking about how these lower prices over here, which are 9 to 10 weeks old, have been coming off. And as that happens, the higher prices will increase the slope of this red line, the 50-day moving average. So what you saw this week was an increasing of that with a down, mildly down week, a little bit less than 1%, but it did close the gap quite a bit. We got as high as 7.5% Tuesday. At the highs of the day before the news of that bond auction came out. So we've gone from 7.5% to 4.7% above the 50-day moving average. So again, that's a combination of price coming down and the moving average is coming up to meet it. That decreases risk. It's something we want to see. We need to work off this bullish condition and keep our eyes on what's working and what's not working. In the meantime, that's why we maintain the leaders list and review the sectors. Dow Jones Industrial Average in this really nice, long 47-day, 5% deep, flat base, sitting on the 21 above the 50, nothing wrong here. Now let's get to where we are having some problems. Mid caps, we've been talking about this for a while, how we've been underperforming in a really bad week for mid caps, near the bottom of the range at this 475, 476 level. Terrible relative strength over the last 5 weeks in mid caps, but even worse, small caps, as I said, down 5% on the week. Still not near the bottom of the range, couple points away from this, but really it's an 11% deep consolidation that's been going on for about 17 weeks. Even if we want to go back and include this even further, you're over 20 weeks. So really, we've made no progress from a relative strength standpoint. Steady downtrend since this area around March. And remember, mid-February is when we really started underperforming and when the growth leaders got hit, and that was reflected in the IWO. And I'm going to go over the 5 ETFs that we track to measure health of growth stocks. But you can see the terrible relative strength over the last 3 weeks in this, but it's been led to the downside by energy and banks. So primarily energy. So the ETFs that we track for health of the market, go over these real quick. QQQJ, you can see that relative strength lagging over the last 2 weeks corresponds to what's going on with growth stocks. ARKK, this is the ARK, Cathie Wood's ARK flagship ETF. Again, you're going to note the same thing, terrible relative strength over the last 2 weeks for this. IWO, which is the Russell 2000 Growth ETF, now sitting on its 200-day moving average. Terrible relative strength there. FFTY, this is the IBD 50 ETF. Again, terrible relative strength under the 200-day moving average. And IPO, I also keep an eye on this one. This is really a risk on, risk off. When IPOs are working, you're going to see this ETF working. And when they're not, again, risk off is what you see very often, and as we've seen for about 2.5 weeks down here to the downside. So enough of the indexes. Let's get to the spider sectors and see what's strong and what's weak. And basic materials with continued weakness. Remember for a while how hot all copper, silver, lumber, anything you could drop on your foot was good. That certainly hasn't been the case over the last 5, 6, 7 weeks. As we're down near the bottom of this 10% deep flat base, relative strength continues to be terrible. And what does that mean? It means we've got one stock, a chemical stock, on our 21 over 21 list, a new addition this week, but we're staying away from any type of stocks that are in the material sector. XLE, energy, again, really weak. Breaking down here, terrible relative strength, no leadership left in the energy sector whatsoever. XLC communications, I'm going in alphabetical order here by these, continues to look fine. Financials, XLF, doesn't look too bad here, but the banks look even worse. Let's look at KRE. There's some non-bank financials that are holding this up better, but the banks themselves have been looking terrible, and that coincides with a drop in interest rates. XLI is next, industrials, kind of going sideways, not really an issue there. XLK got also extended along with the Qs. You can see the relative strength still continuing to rise there, but again, these bad prices from 9-10 weeks ago coming off, coupled with a little bit of a pullback, is narrowing the gap between the 50-day moving average, and we saw a lot of pullbacks in tech this week. Consumer staples, here's where money is flowing into these next couple of defensive sectors. Look at the relative strength this week on staples. XLP, very clear that with the pause that we took in the QQQ, the big tech stocks like Apple, Amazon, Netflix, some money coming out of there, Facebook, some money coming out of there this week, and it flowed into these defensive sectors. Consumer staples, real estate is the next one, XLRE, although this has been really kind of strong for a while. Strong here, 3 weeks of consolidation, now the last 2.5 weeks really showing some strength. And then utilities, boring old utilities, but with some serious relative strength this week after 3 consolidation weeks. So what you're really seeing is when money was, flowing into tech, these defensive sectors going down, money has reversed this week and gone back in to the defensive sectors. 2 left, we've got healthcare, XLV, trending sideways kind of on relative strength, but higher on price. And finally, consumer discretionary. This, a big part of this is Amazon. That's why you see the hook down here, as Amazon gave back quite a bit of its gains this week. So that's what's going on with the sectors, and we've got no utilities, added a staple. Utilities, if we're going to buy them, there usually aren't standouts. We would just buy XLU, which is the broad ETF for the utility sector, as opposed to buying an individual stock. But really, usually the standout in the utility sector is NextEra, which has lagged for a while, but you can see gathering some relative strength recently. So let's get to our lists now. The 21 over 21 list. First of all, let's talk about what got kicked out, and there were a few that got kicked out this week, 7 to be exact, but we really had 23 on the list last week. So some of these that we own, we got stopped out on. Roku, still forming a nice base, but this big volume run up, not enough to overcome the recent weakness in tech growth type stocks. You can see the relative strength lagging over the last 2 weeks. Broke the 21 today. This is still very high on our list to get back into, but we did get stopped out with those 2 closes below the 21. Roku booted off. How about Marvell? This is something that I owned but got stopped out of also when I was making no progress on it, and it really gave way this week. Would have been taken off the list and very clearly sold. I'm lucky to get out with about a 2% loss before it really broke down. ANET, this has been on the list for a while, but just squeaking below the 21, and there really hasn't been any relative strength for the last 4 weeks on that particular stock. Signet Jewelry finally gave up this week after being on for a while with this gap up, and it's not hard to see why we love the 21-day exponential moving average. This is really where the strength is, and when things get below it, they can really blow apart in a while. No relative strength on Signet over the last 2 weeks. Triple D got stopped out on this, and look how this just came apart. I mean, this is one that really went from the penthouse to the outhouse pretty quickly. We had very nice gains in it, getting into it here, adding to it, and then just little by little getting stopped out, and then finally it broke to 21, and our last piece of that got, and now even breaking the 50-day with a bullet this week. NVIDIA, another one, and I think that this is just people front ran the split early next week and tried to on the way up and also on the way down after seeing what happened to Apple and Tesla, how they really peaked after their splits were completed. So still a leading stock, still fantastic numbers, but we don't do participation trophies here at Revere. You break the 21. So we're going to be rare instances when we're still holding on to you, and we got stopped out on 2 pieces of NVIDIA this week. Booked some nice gains in it, though. Let's see what else. ESTC, we hadn't owned this, but this had been on the list for a while, but breaking the 21, and it's gone. So the 5 at the top here, these are listed. Let's show the whole list here. Only 7 sectors this week, but 16 industry groups and 7 spider sectors. When I say 7 sectors, that's out of the 33 IBD sectors, but a lot of them just not participating, and this is really where the strength is. So we're focused on these 7. Normally like to have more, but you can't make strength up if it's not there. So that's the complete list. We're going to start these first 5 are the 5 that were added this week, and if it's flagged, we own it. United Healthcare, owned this in the past, got out of it back over here, formed a nice cut base, and a nice positive reversal shakeout on its earnings report got me into it yesterday. Note the relative strength over the last 2 weeks as money has flowed into healthcare stocks. Visa, very nice. This lagged for a long time, just going sideways. Formed a base, another base on base, and now finally breaking out this week with some nice strength, some nice volume, and very superior relative strength. And when these big stocks outperform, we like to get them on the list. Costco, this is the staple that's on the list. You can see how strong this has been after this breakout from this cut base, just barely 5% above the pivot. Albemarle, this is the basic material stock that's on there as a big move up on Monday, and then 4 days of consolidation sitting on the ADMA. Hopefully this isn't a 1 week wonder, but that was a lot of strength with that 300% above average volume up 7 weeks, forming a very nice cup and handle pattern, stage 2 breakout, and see if it sticks. If not, you know what'll happen to it. CVNA added, looking good near the top of its base, putting in a little bit of a handle here. And those are the 5 that were added. Amazon, we sold this week when it looked like money was starting to flow out because frankly we got in late. We sold initially down here when it broke the 200-day moving average, got back into it when it broke out of the base, but didn't get in right away. We got in on this pullback here, and then when we got back below, again, this is one of our new rules, being merciless with things that aren't going higher. And when we went negative on it, we just cut it. It had another 3% down to the 21, which it did. We didn't want to give back another 3% because we like to not have a stop right on the 21. We usually give 1 to 2% below that. So with money flowing out of here over the last 2 days, I didn't want to say, okay, I'm holding Amazon to 2% below the 50. That's another 6% down. Just not happening. So we got rid of it up here, but we certainly will add back to it if strength comes back into these big cap tech sector tech stocks. And again, still 5% above the 50-day moving average on the Nasdaq 100. So these might go sideways for a little while yet. Apple sold a piece of this week, up about 15-16%, just a little bit too extended, and it ran into this 150 level, plus with money coming out of it. We still have long-term gains in this from back right after COVID. This is one of the ones that we bought for people that have been on board for a while, but terrific relative strength, just finally taking a breather. Chipotle, I stopped myself out on this today with a less than a 1% loss because it has earnings Tuesday and I won't have any cushion, so I'm not going to sit through it. Fantastic stock, great relative strength. Let's see how it reacts on earnings. Lululemon continues to act well. Again, it's flagged. We own this, and small, low single-digit profits on this. PayPal, same situation here, acting great. Bought it when it broke out of the cup and handle. A little bit of a pullback this week on lower volume. AVTR, consolidating just fine. Not really making any progress, though. InMode, this is our latest buy. It's been on the list for a while. Big move up here. Earlier in the week on increased guidance. Love to buy increased guidance as long as the price participates. And nice big day up, lower volume 2-day pullback, hit the 80 MA, pulled the trigger, 2 buys on this today, and we're profitable in it. So as long as it holds this 100 level, we'll be good. RVLV, undercut reclaim of the 21, even though the 21 has rolled over, so we got a close eye on this one, but this is a good story. Vive Systems undercut the 21 but reclaimed it by the end of the day, so that looks good. Net, we still own this. Got rid of a piece when it broke the 8, still holding on as it's sitting right on the 21. CrowdStrike, same thing, sold a little bit of it this week, sitting on the 21, but I mean less than 2% away from our stops on these. And those will wrap up high teen profits if we get stopped out on them next week. DocuSign bounced off the 21 this week. We did sell a piece of it when it broke the 8 and bounced off the 21. Continued strength. We'll add that piece back. T-Mobile has been on here for a while and it continues to act great. American Tower, this is our REIT. I mean, I wish they all acted like this, just riding the 8 higher. Domino's Pizza. Speaking of, I wish they all acted like this. Look at how this is just such an easy hold. It's been on the 21 list forever. As you can see, it's numbered 2 and only Fortinet numbered 1. But man, what a move! And same thing with Fortinet. Really easy hold. Unfortunately, we don't hold them. But maybe you do because you saw them on the list. And that's going to wrap it. Let's see. Let's talk about, I talked about some things that we bought and sold this week. So really, I think everything. Let's talk about a big disappointment this week. MSOS. Bought it here when it tried to break out, got stopped out when it made no progress. This just looks like all of these stocks are consolidating and waiting for something to happen. Maybe that something was Chuck Schumer's legislation. So some volume came into it. We bought it here, and it immediately reversed. We sold it in two pieces, took our loss. Just not working. Don't get married to cannabis is the next big thing when, from 55 to 37 at the highs. Let's see what else Upstart. Here's another one. We got out of the good promise on this one initially in the week with the Goldman Sachs upgrade, but that was great on Monday, Tuesday, Wednesday, Thursday, Friday. Not so much. We sold it at 123, down to 114 now. Let's see, Marvell. I talked about how we got stopped out on that, and I think that is going to cover everything. So we've taken partial profits on a lot of the leaders that we held when they violated the 8 and the 8 rolled over. Holding the other piece, usually 1 to 2% below the 21. So holding on to those, harsh break of the 21, you're gone. And these are, again, some of the new rules after the deep dive that we took earlier in the year about how we're really trying to focus on just the best of the best and get the meat of the move and then move on. I initially said I thought it would cut our losses by a third on the downside, but I'm convinced now it's going to be closer to a half. So that's definitely something that clients will benefit from. So that's going to wrap it. You have any questions? As always, I'd like to hear from you. I'm on Twitter at D Vandenbord, email don@revereasset.com, phone 855-REAL-WEALTH. Wrapping up the week ending Friday, July 16th. This is Don Vandenbord with Just the Facts. Thanks for listening. Have a great weekend.